Fund Watch. Explore funds with the edge. This episode is sponsored by UBS Asset Management.
Good morning. Welcome to another episode of Fund Watch, a webcast series by The Edge Singapore. My name is Jeffrey, and I will be your host for today. In today's webcast, we will explore Asian equities excluding Japan. This broad asset class has done exceptionally well over the past 12 months, despite the impact of COVID-19. Since bottoming at the height of the pandemic, Asian ex-Japan equities, such as those in China, South Korea, Taiwan, to a certain extent, Singapore and Malaysia, India and other markets have rebounded. In fact, the Kospi and TAIEX are near an all-time high. The rally appears to be in tandem with the soaring US stock market. But is the rally in Asian ex-Japan equities sustainable? Are there still opportunities? Joining me today is Shou-Pin. He is the portfolio manager of Asian equities at UBS Asset Management. We will discuss the reasons fueling the rebound in Asian ex-Japan equities. We will also touch on Asia's fundamentals, which have long attracted investors to the region, and whether that has in any way been changed by COVID-19. Finally, we will explore some of the opportunities in Asian ex-Japan equities. Shou-Pin, it's a pleasure to have you today. How are you?
Okay.
Shou-Pin, is your mic on?
Yes, the mic is
You're
on. You can hear me? All right, yeah.
Yes.
Good
Loud
morning,
and
I'm
clear.
good, yeah.
Okay, so let's start off with the big picture. Tell us briefly why you think Asian ex-Japan equities will continue to be attractive.
Okay, let me just take a moment to share my screen. I think you can see the screen here. So the question is why Asia ex-Japan equities will continue to do well. So let's take a look at the big picture first. Now, where do you think growth is going to be coming from going forward? Our view is that emerging markets, of which Asia is a large part, will continue to drive growth globally going forward. If we just take a step back and look at the increase in working age population, now going forward, developed markets working age population is actually going to be decreasing, while that for emerging markets and Asia in particular will continue to increase. So this will basically be driving global growth going forward compared to the past, right? And it's not just working age population growth. This region has got significant investment in education, in infrastructure, in R&D. So this actually set the stage for us to have a very positive outlook for the region going forward.
Now, Asian ex-Japan equities, as I've mentioned at the start, they have rebounded strongly despite COVID-19, which is still around. What are some of the key reasons for that?
Well, global liquidity is one, and that has benefited not just this region, but also the global equity market. But if you take a look at what actually has been driving the performance of these economies over the last year, what transpires that actually some of these economies in Asia have actually done very well despite the pandemic. If you look at the GDP growth globally in 2020, China, Taiwan, Vietnam. These are three of the very, very few countries that have actually registered a positive GDP growth in 2020. So there's good reason for these economies and therefore their stock markets to be doing well.
I see. So economic growth is the reason why these markets are still doing well?
This is one of the reasons, right? You're asking why, why these markets have done well. So I'm saying that, in many cases, they are supported by fundamentals. Because if you look at the economic performance of these markets or these countries, they have actually delivered the growth relative to the rest of the world. So there's good reason for them to be doing well from fundamental perspective. Plus, you also have changes that's transpired over the last 18 months, right? They have actually impacted certain industry, and some of the companies in this region have benefited from those changes. So we can talk about some of those later in this conversation.
Right. But obviously, COVID-19 has made business conditions harder. How do you think companies are managing their cash flow and financial obligations?
So different companies are actually impacted by COVID quite differently. In some cases, companies and industry are really struggling. But in other cases, there are industries that have actually benefited from COVID. So work from home has been a trend that we are living with for the last 18 months, and that's going to be sustained. And some industries are going to benefit from that. So what do? We step back and take a look and ask ourselves whether or not the region in aggregate, okay, is better off or worse off to deal with this crisis. So we look at the balance sheet for the Asian companies. You look at what I'm showing or sharing on the screen. The debt to equity ratio in aggregate is actually still relatively low. So that's on a company basis, right? And so we believe that in aggregate, this region should be able to ride through this crisis reasonably well. And we look at it from a country perspective, right? Compared to the past two crises, that's more financial in nature, the Asian financial crisis, the global financial crisis. The balance sheet for the countries, the respective economies are actually better. Take a look at the current account situation. We are actually a lot better positioned than we are 10 years ago when the last crisis hit.
I see. But looking at the chart, for the last 3 years, it appears that the leverage levels, as for the net debt compared to equity for Asian ex-Japan companies, it seems to be on an uptrend. Is this something that is worrying for you?
No, I think the aggregate level is still fine, right? I mean, the debt equity ratio itself is just one parameter. If you look at the ability to be repaying the debt, it is still in a level that we are very comfortable with.
I see. All right. Now, you mentioned earlier that one of the key drivers for Asia's growth story is its huge population and growing affluence. Has COVID-19 changed that?
No, not really. The trend is a positive secular trend that we believe in. COVID hasn't changed that. The nature of demand may have changed, right? Less global travel being one example. That would come back, but maybe come back slowly. But the fact that there's a growing middle class in this region is actually very positive for investment, and we can find it in some of the themes, that we can discuss about later.
Right. I believe that you see three exciting themes across Asia. One of them is technology. Tell us more about it.
Okay, so let's look at this slide that I'm sharing on the screen, right? I mean, this is showing the operating margins of DRAM companies. And the first thing I would say is that if you look at this chart compared to 10 years back, there are actually a lot less companies now that are producing DRAM. You can also see that the profitability of these companies have been improving. So what this chart is showing is that in semiconductors, the supply side discipline has been kicking in because it's now more expensive to invest and make new fabs. The entry barriers are higher, and therefore the industry structure has become very positive. Now, what has changed over the last 2 years? What are the two significant events, if I may ask, that actually have changed the world in the last 2 years? One will be COVID, and one will be the geopolitical tension between US and China. And these two events will actually be impacting our lives going forward. Now, what these two events has in common is that it's actually brought into sharper focus the importance of supply chain to a region, right? Whether it's a country, whether it's a region as a whole. Now, I think none more so than semiconductor, because semiconductor is really what's going to be powering technology going forward, right? We are doing this Zoom call, we are seeing videos, your phone, all these are going to be powered by semiconductor. Now, the key is this: the best assets for manufacturing for semiconductors are actually located in Asia. The majority of assets are also located in Asia, right? That's why you can see that the US is actually quite thinking that it's really important for them to try to get some manufacturing back into the US. So Arizona is basically putting out the carpet to invite TSMC of Taiwan and Samsung of Korea to invest there, right? And Intel is going to be building more fabs there. At the same time, China will have to be investing more. They have been investing to try to catch up. Because this is where there's a bit of shortfall as well in terms of their self-sufficiency. So we see a very conducive environment to find good investment candidates, right? Because China, we know that they are going to invest, right? Particularly if the threat of US ban always hanging over their head. So we can find investment candidates there that will actually benefit from the increased investment in semiconductor in China. At the same time, we are able to invest in already global companies, global world leaders in the likes of TSMC in Taiwan, in the likes of Samsung in Korea. So we are actually very positive on this particular sector, and we think the runway for growth is actually quite good going forward.
Your focus is on the hardware segment of technology. What about the software segment?
Oh, okay. So we talk about some of the trends that we like, right? That doesn't mean that outside of these trends, the other segments would be segments that we ignore. So there are still good companies in software. There are good companies in IT services, and all these are under the tech umbrella. Internet, is classified no more under technology. But again, there are good companies there, and we have the research resources to be always looking at this. But we are talking about some of the trends that we are positive on, and from an industry perspective, we think in a semiconductor is one that we are reasonably excited about. But that's not to say that we think that software is no good.
I see. Now let's move on to the next theme, which is credit growth. What does this mean? Could you please elaborate?
Okay, so as I mentioned just now, right? In this region, economies are actually at different stages of economic development. So usually when economies develop, so too will its financial sector. So let's take a look at this chart. So what this is showing is that, if we look at the developed markets, which is more on the right side of the chart, you will find that the credit to GDP is of a particular ratio, right? And if you look at the left-hand side of the chart, which basically mainly your developed economies, in some countries, credit as a percentage of GDP is still relatively low compared to the more normal level of the developed markets. So particularly you look at Indonesia and you look at India sort of just in line. So what does this mean? This means that as economies developed, you expect credit growth to grow faster than the economic growth, right? Just so that it's going to catch up with the global normal. So what this means is that if we can find banks, right, that would continue to take market share in these economies, then those will be very good investment candidates. And it's actually not that difficult because the good banks in the likes of India, Indonesia are easily identifiable. They have been gaining market share, but their market share is still relatively low, and they will continue to do so, right? Because most of the time they are gaining market share from the state-owned banks. And that's not to say that the state-owned banks are not run properly, but the state-owned banks have got the burden of legacy loans and policy loans. So the narrative is very simple. These banks are going to continue to gain market share in an industry, which is the banking industry, that is going to grow faster than the economy, right? Because the credit penetration is still low. And the economy is going to grow faster than the rest of the world, right? For the reasons that we discussed. So this narrative we can actually repeat for a good number of years. And you've got to what we call compounders. And those are very good investment candidates in our opinion.
I see. Now let's move on to the last theme, which is lifestyle upgrading. Could you tell us more about this?
Okay, so the story here is very simple, right? As I mentioned, the economies continue to develop. People will become richer. The middle class is growing. So what it means is that as you become richer, as you become more affluent, your lifestyle change. So what we want to do is to position our investment that will be able to take advantage of this trend that we can see going on for a long while. And you just ask yourself, right? I mean, what your parents are spending on, would be quite different to what you are spending on, and probably it's quite different from what your kids are spending on. Let's look at this chart, right? Let's look at India. So this chart basically shows the wallet share in terms of spending in India, 10 years ago, 5 years ago, and currently. And you'll see that 10 years ago, most of the spending, or close to half of the spending, is to basic necessity like food, beverages, and tobacco. But increasingly, you'll find that the trend is shifting more towards services, towards more the discretionary products, whether it is education, whether it's transport, communication, and so on and so forth. Right. So as people get richer, the emphasis on consumption would change, and what we can do is to find investment candidates that would actually be playing towards this trend. So even within the same product category, right? Even within the same product category, there's another powerful trend that we see is happening and will continue to be so going forward, which is that within the same product categories, as people get more affluent, you will see the demand shifting from very basic brands to or functional brands to more the premium product. So let's look at this situation, right? Baijiu, which is a form of liquor in China. In aggregate, you can see that the baijiu consumption has not been growing, right? And it's not forecast to be growing going forward. But you look at the ultra premium brands, right? The growth there is actually really good. So you look at companies like companies like Wuliangye, these are the premium baijiu brands in China, and they've been enjoying very, very good growth, despite the fact that the overall product category is, the demand is only flattish. So again, this is a very powerful trend that we see has happened and will continue to be so going forward. And hence, those are very rich hunting ground for us to find stocks, to put into our portfolio.
So you have mentioned examples in India as well as China, but is the shift in consumption patterns similar across Asian markets?
Yes, I would say so. I mean, in some cases, right, in the more developed economies like Singapore, like in Hong Kong, some of these trends have already been playing out, right, and to varying degree. And then, of course, you look at the countries in different stages of economic development, whether it's in Indonesia, Malaysia, Thailand, and so on and so forth. A similar trends is also playing out, right? So you can actually see this. And the key is really to pick the right companies in the right markets to benefit from these trends.
Thank you for sharing the themes. But how do you translate this to your Asian equities strategy?
Okay, so we have a fund that is invested in Asia ex Japan, and the way we look at it is to stick to our investment philosophy, which is really buying good companies at a reasonable price, right? So we have actually a very good team that have been working very well together. We have boots on the ground research that will actually give us, very good feedback on where the company is in terms of their industry positioning. Now, for this particular fund, I would share that there is a 30% or so allocation to the mid-small cap asset class, because this is where we find that the opportunities to discover companies with long runway for growth, because size is still small, and also because size is small, the market tends to ignore it, and therefore there's a greater case for us to find mispricing. So this is how we do it. And the other thing is that once you have an allocation to the mid-small cap asset class, you actually achieve the required level of diversification, in our opinion. So the balance 70% or so, we are actually able to invest in large cap, typically the global leaders or the industry leaders, and we are able to do so in a concentrated manner, so that we can actually maximize our returns, given the work that we have done on these stocks.
I see. Now, ESG is increasingly talked about. How do you factor this into your strategy?
Okay, we do have a strong emphasis already on governance, even before ESG, become a term that's been widely discussed. And of course, as things developed, we refined the process when we incorporated, the ESG aspect of investment into our process in a more structured manner. So what do I mean? So the first thing is that we start off with boots on the ground, right? What it means is that we need to understand the company, and a lot of time we actually do vertical check, horizontal check, and we actually place a lot of emphasis on trying to understand if the management is good. So that's the governance aspect. But this is not enough, right? So over the last few years, we have developed a UBS integrated approach to looking at ESG, and so we have a framework that would actually flag to us whether or not the ESG score for the companies that we are looking at is acceptable. And once we have got that as a starting point, we then look at each of those scores and try to understand whether or not there are actually areas that we can improve, or if it doesn't quite match our quite match up to our scoring passing mark, we try to understand why, right? Sometimes it could be a data issue, right? Sometimes it could be just that it could be a disclosure issue. So this is where we have engagement with the companies and so on and so forth. We actually have a separate ESG team on London that will actually help us with this as well. So approaching the same subject, from a more specialist angle compared to fundamental analysts like ourselves. But we always have a ESG emphasis on our investment for many years already.
How trustworthy is the ESG data? I mean, there are a lot of claims out there saying that this data is, unreliable. What are your thoughts?
Okay, I think that's a bit of a loaded question, right? Okay, the way I look at it is this, right? When you look at external data, and you do make use of external data, we therefore have to rely on their data source to some extent, right? But this actually, in our framework, just give us a starting point, right? So with the external data, okay, we have a framework that we know how to analyze the ESG aspect of any investment, and we say that, okay, all right, does this pass or does this not pass? Right. If it's an investment that we are considering and it doesn't pass our framework, the first thing we need to do is to understand why. And that's where, as you said, we go on to the data, the raw data that comes out from each of these various sources. We understand why is it that it gives us a failure score, okay, within our framework. Now, even for companies, okay, that passes through our framework and it come out as being not having any ESG risk. If we are taking a significant investment in these companies, we also have to understand those ESG score, where they're coming from. And typically the fundamental analysts as well as the ESG analysts, we will have a view, right? And so even in instances where there's no problem with the data, we can actually look at the data and try to understand where are the differences in respect to maybe the highest benchmark that we can set for the industry in terms of ESG. And this is where, in talking to the companies, we can engage with them and see whether or not there is case for improvement, even though they are really good enough.
Thanks, Shou-Pin. I think what you've shared is really helpful. We had actually one question from our viewers asking about this, and I think you answered it well. Now, I'd like to move on to my final question before we move on to Q&A. As I've noted at the start of the webcast, Asian ex-Japan equities have rebounded strongly. Do you think they are overvalued now? Do you think investors should get in now?
Okay, I will answer the two questions separately, right? Are they overvalued? So let's take a look at this chart. So if you look at this chart, you can see that valuation for Asia ex-Japan is trading at probably at the higher end of its valuation band. So I would say that relative to its history, is no longer so attractive, but I don't think valuation is excessive, right? And there's good reason for that rebound, because economic recovery is on track, and also there's abundance of liquidity. The thing that I want to point out is that relative to US and Europe, the risk reward, in our opinion, is probably more acceptable, right, compared to the other market. So that's the first thing, right? After doing so well, obviously, things are not as attractive as it was 1 year ago. But to be honest, 1 year ago, we were looking at a pandemic that's just happening. it was very difficult at that point in time to say that the markets could have done so well, right? So let's be honest about it. So just looking back and thinking about where we are now, I do not think Asian equities are overvalued. I think they are maybe at the higher end of its valuation band. So the important thing for us is to find good companies, that are able to deliver good earnings. And if that's the case, then valuation can be sustained, and you will be able to get returns commensurating with the growth that those good companies will be able to deliver to you. So that's the first point, right, regarding the valuation of the markets in aggregate. Now, your second question about whether or not investors should get in now. So this basically comes to market timing, so as to speak. I would advise against market timing per se, because it is really, really difficult to do, right? What we want to focus on is to say that over the long run, equities will probably give you better returns compared to bond, and bond will give you better returns compared to money market. So for individual, I would actually ask individuals to look in terms of their own personal wealth asset allocation. If you are buying stocks, I would focus on buying quality companies at reasonable price, because in the long run, this will work out for the investors, right? Rather than to say that, oh, this is the right time to be buying, this is not the right time to be buying. I would rather focus on individual companies rather than to say that the market as a whole is cheap, the market as a whole is expensive. And that's basically the philosophy when we actually comes to picking our stocks in our portfolio.
Thank you, Shou-Pin. We will now take some questions from our viewers. Okay, we have one from an anonymous attendee. The question is, interest rates are expected to rise ahead. If that happens, how would that impact Asian ex-Japan equities?
Yeah, I think this is a very valid question, right? And we have also discussed that internally. The question is to try to understand why is interest rate rising. If you look at it historically, if interest rate is rising as a result of strong economic performance globally, then usually it's good for emerging markets, including Asia. Okay, so we got to understand that when interest rate rise, what is the reason? Is it because demand is back, economic performance is actually strong, or is it because of some other financial situation, or is it because of bad inflation, so to speak, right? There are good inflation and there are bad inflation from a financial perspective. So if interest rate is rising, but that's driven by strong economic performance globally, then typically Asia ex-Japan would actually do well relative to the developed market. That's history. I don't have a chart to show you, but that's the work that we have done, and that's the conclusion that we come to.
I have a question from a viewer named Raymond. He's asking about Indonesia banks. Do you have a view on that?
Okay. We like the Indonesian banks, right? Okay, put it this way. Indonesia is a market that maybe is not the most liquid when you look at the whole region. So when you buy Indonesia, right, and you want to look at the economic performance and you look at the longer term story, we're actually very positive on the country. And the way to access that will be through the banks, right? And if you look at where the Indonesian banks are now, valuation is actually quite decent, right? I would even say that over the longer run, it is attractive. In the near term, what we need to ride through is basically the COVID situation. If COVID remains under control and we get economic recovery going forward here in Indonesia, then we do think that the banks is one of the better way, if you are managing a big fund like us, to access the recovery in the market. So yes, we are positive, but we are also very selective on which banks that we are picking.
Okay, we have a question from YNT. This person is asking, how sustainable is the rotation into tech stocks?
Okay, I need to first clarify where is that thought about rotation into tech stocks, right? I can understand that from a global perspective, you can see, okay, the semiconductor index have done well, and therefore you would think that there's been rotation there. But actually, what you can observe in the last 3 months is that maybe there's been rotation out of that sector into the more cyclical sectors, right? Like commodities and so on and so forth. So, rotation by the market is always taking place, and it's very difficult to chase after liquidity that is popping from one market or one sector to the other. Within the context of Asia ex Japan, for example, let's say in Taiwan is dominated by the tech sector, and the sector has done well. Actually, over the last year in 2020, but since the beginning of this year, you can actually see some of the more traditional sectors, right, the non-tech sectors doing well. So within that market, you actually see some of that flows already reversing. So I cannot answer that question per se, because I think the starting point of understanding whether or not there has been that rotation into the tech sector, our understanding is maybe a little bit different. In China, for example, right, the tech sector has actually done really well in 2020, all the way through to the point where the sanction on Huawei come in and continue to do so, right? Because that actually accelerated the need for China to gain self-sufficiency. But if you look at the tech sector for China, for example, and again, I'm talking about hardware rather than the internet, those stocks have been coming down, and it is as a result of rotation out. Yes, so I don't have a very good answer for you, but I would say that if you look at Asia ex Japan itself, I don't see a very clear trend that money is shifting. Well, I see money shifting from one sector to another, but our job is really to focus on the fundamentals and say that, okay, we still like this sector, we still like this company, and if the stock is not too expensive, it is something that we'll still continue to hold.
Okay, great. I think we have time for only a few more questions. This is a series of questions from Ryan Xia. He's asking about what is driving the market volatility these days, and what is your outlook over the next few months? Are you guys shifting from growth stocks to cyclical/dividend stocks for your clients?
Okay, so two things, right? Number one is I would refrain from making market commentaries, right? And because I really do not know whether I'll be right. Why is the market more volatile and so on and so forth? So, it is more personal opinion in this case. Has the market been more volatile now versus 6 months back versus 12 months back? Arguably, but if you look at the VIX itself, it's really neither here nor there as well, right? So I wouldn't say that the market is that much more volatile per se. I would say that the market is now trading at a higher level compared to what it is a year back. And therefore, usually, as a market break new highs, you may get a little bit more increased volatility because investors may be looking to lock in some profit. But that's a market commentary, right? Rather than to say that fundamentally, I understand why liquidity has been going up or liquidity has been coming down. But I think what I said is reasonable, right? So that's one. And also, you see that in US, for example, there's been increased retail participation, and certainly in the likes of Taiwan, right, day trading has been increasing. So all those would actually add to volatility. So that's understanding or trying to understand the reason behind that, but it doesn't really tell me what to do in terms of my investment, right? I would actually just go back to the fundamentals to buy good companies, buy them at a price that's acceptable to you. So that's the first question, right, in terms of volatility. The second is again, whether we are shifting from value to growth or growth to value. Again, what we do in terms of picking stocks is that we don't look at the company and say that's a value stock. We don't look at a company and say that, okay, it's a growth stock, right? We look at a company, we ask ourselves whether it's a good company, whether it can deliver the earnings growth that we think is sufficient to justify the valuation, and therefore we buy some of those. Now, what I can tell you is that, okay, over the last year, okay, we have gone from overweight in one country to underweight, just over the last 12 months, because some of the stocks that we have bought, we think have become expensive, and therefore we switch out, right? And we go and buy something else. So, and there's been that shift in terms of allocation for this particular country. So what I'm saying is that we have been doing these changes, but it's more driven by individual stocks, bottom-up consideration, rather than thinking that, hey, right now, maybe it's time to buy value, and maybe it's time to underweight growth. That's how we do it. There's no right way to do it or wrong way to do it, but that's the way we do it.
Thank you, Shou-Pin. Thank you for sharing your views today. With that, we have come to the end of today's discussion. To our viewers, we hope you enjoyed today's webcast. Do subscribe to www.theedgesingapore.com for more updates. Again, my name is Jeffrey. We will see you on the next episode of Fun Watch. Thank you and goodbye.
Thank you.